We continue with video 2. The leases, there are two ways in which the payments could be made. So when you're reading the questions, look out for one of these two words. Look out for the word arrears and look out for the word advance. So we're going to illustrate these two words in these two pro formas. If the lease rentals are paid in arrears, then we go with this first pro forma. First, to the lease liability, you add the interest rate using the interest rate implicit. So you multiply the interest rate implicit by the present value of the future lease payments. Add that interest to the future lease payments. Then subtract the lease rentals in arrears to give you the closing balance of the lease liability at the end of the year. So from this illustration, we assume that we are being asked to report on the lease at the end of 31st May X1. The standard requires that the lease liability should be split into the non-current liability and the current liability portions. To do that, we compute the closing balance for the following year by doing a similar calculation. Apply the interest rate implicit on the closing balance of the lease liability at 31st December X1. Take out your lease installments to give you the closing balance at 31st December X2. The balance at December X2 becomes your non-current liability portion under December X1, and then the difference between the December X2 closing balance and the December X1 closing balance, you get the difference between those two. That difference becomes your current liability portion for the December X1 statements. If the rentals are in advance, they will not be included in the opening lease present value of the lease liability at the beginning of the year. So instead, you just compute the interest rate, which you add to the opening lease liability to give you the closing lease liability for December X1. So to split the lease liability as at December X1 into current and non-current, you subtract the installment in advance from the liability of X1. What you get after subtracting the installment is your non-current liability portion for December X1, and the difference between the non-current liability and the liability as of December X1, basically, which is the installment in advance, becomes your current liability portion for December X1. We apply this now in the question. We have a question: a company leases an asset on 1st January X1 The terms of the lease are to pay a non-refundable deposit of $575, followed by 7 annual installments of $2,000 payable in arrears. The present value of the future lease payments on 1st January X1 is $10,000. The interest rate implicit in the lease is 9.2%. Required, what's the interest charge in the statement of profit and loss for the year ended at 1st December X1. Requirement 2, what are the current and non-current liabilities balances included in the statement of financial position as at 1st December X1. The interest charge will simply be the interest rate implicit times the future lease payments of 10,000 which gives us 920. Then we move to the second requirement. Since the lease rentals are in arrears, it means we first add the interest to the opening lease liability before we subtract the installment. So we've got our liability there of 10,000. To that to add the 920 finance charge, then we subtract the 2,000 installment in arrears to give us the closing balance of 8,920 as at 31st December X1. So it's this 8,920 which we need to split into the non-current portion and the current portion. To do that, we apply the interest rate implicit to the 8,920 to give us the finance charge of 821. Then we subtract the lease rental of 2,000 to give us the closing liability at the 1st December X2 of 7741. So the lease liability at the 1st December X2 of 7741 becomes the non-current liability of December X1, and the difference between the 8,920 and the 7741 becomes the current liability portion for December X1, which is 1,179. We have already explained how the right of use assets should be disclosed separately from other assets in the statement of financial position or in the notes. If a right of use asset is not disclosed separately in the statement of financial position, it should be included in the same line as the corresponding underlying asset would be included if it were owned. Right of use assets which qualify as investment properties are an exception. These should be presented within investment property in the statement of financial position. The lease liability should be disclosed separately from other liabilities, either in the statement of financial position or in the notes. The balance remaining at the end of the year needs to be split between non-current and current liabilities. We just demonstrated that in the previous question. So that's the pro forma of how you need to show the non-current liabilities and the current liabilities under the equity section of the statement of financial position. The interest expense on the lease together with the depreciation on the right of use assets, these should not be grouped but shown separately as a finance charge and a depreciation expense in the income statement. So the interest expense will be shown separately, the depreciation on the right of use also by class of underlying asset is also shown separately. We look at another question for a lease contract in advance. So company A makes up its accounts on the 1st December each year. It enters into a lease as lessee to lease an item of equipment with the following terms. Inception of the lease is 1st January X1 with 5-year lease, 2,000 payments at commencement of the lease, followed by 4 payments of 2,000 payable in advance. The fair value of the equipment is 8,000. The present value of the future lease payment is 6,075. The useful life is 8 years. The interest rate implicit is 12%. Required, what's the value of the right of use asset in the statement of financial position as at 31st December X1, which is the end of the year. Then requirement 2, what is the non-current liability balance in the statement of financial position as at 31st December X1. We start with at inception. At inception, the right of use is initially measured at the lease liability of 6,075 plus the payment made in advance at the commencement of the lease. So the total of 8,075 is what will be recognized at the beginning of the year. And then the right of use asset will be depreciated over the 5 years, being the shorter of the lease contracts, 5 years, and the useful life of 8 years, so we go for the shorter. So 8,075 divided by 5 gives us depreciation of 1615. We get the carrying amount cost minus depreciation to give us 6,460 as the balance, closing balance of the right of use asset at the 1st December X1. And then the liability, we do a working. We start with the lease liability, present value of the lease liability, which is 6,075. Because the lease rentals are in advance, so we simply add back the interest rate implicit at 12% of 6,075, which is 729, to give us the closing liability at 31st December X2 of 6,804, which we now need to split into the current and non-current portion. So we subtract the advance rental payment of 2,000 to give us the closing balance at the beginning of 1st January X2, which becomes our non-current liability portion of December X1, and the installment of 2,000 becomes our current liability of December X1. So we have our financial position there. The non-current assets 6,460,000, the non-current liability 4,804. We now move to recognition exemptions, which will continue in the third and last video.